Hi, everyone. Well, we've got a minute. I'd like to tell you about an exciting new tool that we've developed to use to manage money for our clients. Um, the challenge with the markets in the last year or two has been increasing volatility. Um, There's been a remarkable increase in volatility. We've had sudden drops in the market with very little warning. And the solution is a strategy that involves a tool called hedging that's so effective that we've begun to call it our shock absorber strategy. In 2008, 2007, the stock market began to roll over, and it was sort of normal back then to get months and months worth of warning before we really needed to get out of the way before big losses. You can see in 2007 we had 6 months of warning before the market really peaked and went down. In early 2008 we had another 6-month period where it would have been easy to get out with minimal losses before the big declines of 2008 that we all remember. What's really changed is in 2011, the market cycles compressed and became very short. In early 2008, we had an up cycle. It says, "Oh, it's time to get invested," and all of a sudden it turned around and went down. Market was going down. We said, "You know what? We better get out because this could be a big one," and the market would turn around and go right back up. We'd get in and the market would turn around and go down, and we say, "You know, this could be a big one because all big declines start out just like a small decline." We'd get out, the market would go back up. And all of a sudden, clunk, we had a 16% decline in the market in only 11 days from the peak to this bottom right here. The speed with which these cycles are changing is really what's different in the market. What we're excited about is a technique we've developed. I actually did a trade based on this in early 2009 and then sort of forgot about it until this presented itself last year, and we dusted off this technique, and it works very well in this kind of a market. To give you an idea, this is the trade we did in 2009. This is the first couple of months of 2009, about 2.5-month period, where this retail stock index lost 14% of its value. In the same period, a technology index lost 17% of its value. When we put those two, the technology and the retail stocks, the red and the blue lines, up against the S&P 500, which is the green line, we can see that the S&P 500 actually lost a lot more money. It lost 27%, while the technology and the retail were losing 14 and 17%. This shaded area that gets wider and wider in here represents a performance difference that we can capture with a technique called hedging. And what we do is, because these investments tend to go up and down at the same time, you can see it there, if we flip this S&P 500 over and buy what's called a short fund or an inverse fund that does exactly the opposite, not only does it go down when everything else goes up, but it goes up in general. So we get a pattern that looks like this if we buy the inverse fund versus the S&P index itself that's going down. So this is a technique called hedging. Let me show you how it worked. In the same period, in early 2009, we had the retail index that was losing 14%. We paired it up with an inverse S&P 500 fund, and not only did we make a nice gain during that period of time, this was over an 8% gain. This is a fairly smooth progression, which is really what we're after in these volatile markets. We want to absorb the shocks of the markets. This is the same technique with the technology index that ultimately ended up down 17%, paired with the inverse of the S&P 500. Look how smooth that line is. That was about a 6% gain. And when we put the two together in a portfolio that's half technology and retail and the other half inverse S&P 500, we get about a 10% gain, almost the exact difference in the performance between those indexes and the S&P 500 in a fairly smooth progression at the same time as the S&P was going in the tank and everybody was jumping out of windows on Wall Street. The smoothness of this line is really what we're after in these volatile markets. It's one of the key things is to smooth out the volatility. Current holdings that we're using with this strategy right now include a pharmaceutical index, home builders, real estate, and retail stocks. And we've matched them with a investment that goes up as the euro goes down. Right now, the euro is the weakest. These indexes are the strongest, and that's what we try and do: use the weakest for the short, the strongest for the long, so we can gain the difference in the performance. Here's the performance in November and December of that portfolio. This is not an actual track record because we didn't own all these investments for this entire period. This is just to show the relative risk that we've been able to create compared to the S&P 500. It's not perfect. This was a 3 or 4% decline right there, but the stock market also went down about twice that much in the same period. So this is doing exactly what we want it to do, and that's why we call it the shock absorber. You can see how much more smooth it is than the S&P 500. Now, there's no perfect investment. We all know that. So what can go wrong? The investments can lose the relationships to each other, how they're synchronized. One of the 4 strong investments might not be strong for a while, or the hedge might get out of phase with the rest of the market. In those cases, we need to analyze those situations and change those investments. We could get situations where the hedge just goes the other way, for whatever reasons markets change. Or maybe a bull market begins and everything changes. So these are all things that we want to be able to address. Here's what happened in early 2009, that same period, 2.5 months in early 2009. What's really different there is the bull market of 2009 started right on March 9th of 2000, where I've got this yellow line here. And you can see our hedge was doing great work, and all of a sudden it goes in the tank. As the stock market goes up, the inverse of the S&P goes down. But look what happened to our long investments. They both went up. And our portfolio just sort of went along. It was sort of a yawner. The key here is this gives us time to analyze the changes in the market without giving back huge chunks of the money that we've made. In this case, I cut the chart off at March 12th because that's when we actually recognized the change and made changes in all of our portfolios at that time. So we would have made changes in this at the same time. Probably cut the hedge back dramatically, and maybe added a couple of more investments on the long side. So we are continually looking at investments to make sure that they are the right, the strongest ones to be invested at the top of the market for the strong side, and have the right hedge. We can adjust the amount of the hedge, and we've got a calculator that does that very precisely. And these are some of the reasons that we still monitor every investment we hold for our clients every day as the markets change. So if you're interested in this type of a strategy for your investments, okay, you've got to take some action. Something has to change. Give us a call for a free consultation. Phone number's right here, and it'll be on the last slide in just a second. Our process is very simple. We only ask you to make one investment decision, and that relates to how much risk you want us to take or avoid. We will personalize strategies for you, and there are no long-term commitments. There's no commissions, no exit fees, anything like that. The door, whenever, there's never a door closes in your life, investment-wise or otherwise, that there isn't another door opening. This is a good example of how we can make money even in down markets. So the door is open for you. You just need to call us and come through that door, so the door to Hepburn Capital Management, so we can help you. Please contact us. You can see our contact information here. If you're not happy with everything in your financial affairs, something has to change. You have to take that first step. We can take care of the rest, but something has to change. So give us a call. We'll look forward to talking to you, and thank you for spending a few minutes with me.